let's begin, first of all, by talking about the September effect. So you know that yesterday I sent out an email, came out to you last night, talking about this September effect. September is traditionally the weakest month for U.S. stocks. And we're just 3 weeks away. And if you take a look at the markets this morning, let's pull up just a real quick look at the markets and see how they're looking. There's quite a bit of red. We see that volatility is beginning to pick up. We see that the Russell 2000 is pulling back, the NASDAQ is pulling back, the S&P is pulling back, and the Dow is pulling back. So we do have some broad, a little bit of a broad pullback here beginning. And we're going to talk about what that means, how you can actually potentially profit from that in today's webcast. We're going to have some ideas. But overall, just keeping all of this in mind now, is that the September effect is pretty darn accurate. When we go back and we take a look, for example, at the average monthly returns in the S&P since 1928, you'll see that September sticks out like a sore thumb. It's the one that has a more than 1% decline. Here's your legend up here, or here's your chart here where you have, negative 1%, negative 2%. Here's the zero line, plus 1%, plus 2%. This July is one of the best months of the year. In fact, it is the best month of the year, just based upon average monthly S&P 500 returns since 1928. That's almost it's almost a century of data there. But when you look at other months, April's another really good month, January, very good month, and December, right? But September sticks out like a sore thumb. It's this month where we tend to have weakness. And, it's one of the more interesting cycles in market history. Now, we talked about in the email last night that September is interesting because there's many things that have happened in September over the years that seem to confirm this effect. So like back, for example, when Lehman Brothers, imploded back in 2008, well, that was, in September, and that sparked a full-blown economic crisis. You go back to 2000 with the dot-com bubble, which began to break down in March, but the bear market really began to accelerate in September of 2008 of that month. The 1998 Asian contagion, you may remember, the financial crisis from that year, really roiled the market between August and October, with September right there, sandwiched in between. Then you have the crash of 1987, right? That arrived in October, but stocks, but guys like Paul Tudor Jones were noticing problems in the market in September, and he began to see the warning signs. That's how he was able to profit from the sell-off in October. So it didn't arrive out of the blue. There were warning signs in September. If you go back to 1929, to the Great Depression, the stock market peaked just after Labor Day, just right after Labor Day. And then it began falling in September, and then, of course, into October. But if you look at the worst monthly decline in the U.S. stock market during that entire Great Depression, it came in September of 1931. The Dow Jones fell around 30% in that month. You have the Great Panic of 1907 that began in October, but the warning signs became very evident in the month of September. You have the Great Crash of 1873, begins in September, right? So when we think about the month of September, we say, well, does that mean that we're going to have a crash whenever September rolls around? Not necessarily, but it tends, for whatever reason, and there's all kinds of reasons. Nobody really knows the exact reason, but there are all kinds of theories. One of the big theories has to do with the fact that it's kind of back to school month. It's kind of where people kind of move out of their summer slumber, and they begin to get back into the groove of things. They get back into the office from their vacations. They get back into the schoolhouse after their summer vacation. And everybody's just kind of getting back in the groove and preparing for what really becomes this Q4 of lots of national holidays and lots of get-togethers, and of course everybody's beginning to prepare for Christmas, and they start buying. Well, the point is that as they get back to the office, as they get back to the schoolhouse, and everybody's kind of getting back in the groove, well, at that same time, they start kind of shifting their portfolios, right? And this is a real common thing that happens. And so there's this portfolio effect that seems to be at play here. But there's really not, a single theory that explains it all. We don't really know why September is this way, aside from just basic theories that we could just, put out. But the truth of the matter is that if you're going to have those kinds of problems, you'll tend to begin to see them around this time. Usually in August, you start to get signs that things are beginning to weaken. And then oftentimes in September, and then, October used to be a terrible month. It's become a month that's actually a little better. September's still a tough month. But so as we look forward, we realize we're just 3 weeks away from September, and we could be due for a sell-off. There is this historical tendency for a downturn to arrive in September.